Hey everyone, James here from Northeast, and I'm here today to talk to you about asset allocation. Now, if you go and see a financial advisor, then invariably asset allocation is a term that you're going to hear. And the reason that you are is because it is absolutely fundamental in terms of achieving the returns that you want, and also, very importantly, doing that at a level of risk, with a risk tolerance that you're comfortable with. When we talk about asset allocation, one of the first places that we need to go to is what we call asset classes. And broadly, there are 4 asset classes, and they're captured just here. You've got your growth assets, and we typically describe these assets as being shares and property. Shares being equities, and then of course property being not just your home or an investment property, but also commercial property like shopping centers and commercial properties. And then we move across to defensive assets, and defensive assets tend to be your cash and your fixed interest. Obviously, fixed interest being investments whereby you're locking away your money for a set period of time at a given interest rate, and the interest rate will vary based on the level of risk that with which you're locking your money away. The reason why this is really important is because these asset allocation types, both growth and defensive, do 2 very different things. If we look at the long-term returns of a defensive investment, for example, like this blue line, what we're going to find is that in most cases, the performance of a defensive investment is very steady. You don't see a lot of volatility, and in return, you tend to see fairly low growth over an extended period of time. Conversely, with your shares and your property, your growth assets, you see the opposite. You see much higher volatility. It's not uncommon at all in these sort of assets to potentially drop 20-25% in a single year. That happens typically once a decade at least. And so with that in mind, the volatility is higher, the swings are higher, but the trade-off is that the long-term returns that you receive are also going to be commensurately higher. So if you plot this on a graph, it looks a little bit like that. If you're going to invest in your growth assets like shares and property, then the promise is that you get a higher level of return. And you need that higher level of return to take into account the fact that you're taking more risk by investing in these positions. And the risk, of course, is the uncertainty of the return. Whereas with a cash investment, that the risk is very low, the certainty of the return is very high, and so the return is very low. Fixed interest is slightly riskier, the certainty of return is a little bit higher, and therefore the return commensurately needs to be higher. So a very simple rundown, but really important to understand these asset classes and understand the balance for you as an individual that's going to enable you to, again, have as much exposure to growth assets as possible, because that's how you're going to make your money, but also do that in such a way that you don't have the sleepless nights because you have insufficient exposure to defensive assets. Thanks everyone. Chat soon.